Imagine you're watching a stock you own climb higher and higher. You glance down at your trading screen, and a special gauge at the bottom, a momentum meter, kicks past the number 70. If you've spent any time reading beginner trading advice online, you've probably heard a golden rule for this meter. If it drops to 30, you buy. If it hits 70, the asset is considered overbought, and it's time to sell. Following the instructions perfectly, our beginner trader sees that needle touch 70 and immediately clicks sell, locking in a modest profit and feeling pretty smart. But look at what happens next on this chart. The price doesn't drop. Instead, it blasts right through the top of the screen, climbing for weeks. Meanwhile, that gauge just stays pinned above 70. Our trader just missed out on massive gains. Why did a piece of advice repeated on thousands of finance blogs just fail so spectacularly? The problem is that treating a financial gauge like an automatic fortune teller turns a genuinely helpful tool into a dangerous trap. That gauge is called the Relative Strength Index, or RSI. You can ignore the complicated name. It is simply a mathematical speedometer. It calculates how fast a price has moved recently and spits out a number between 0 and 100. Think of a stock that is steadily climbing upward as a car cruising on a straight, wide-open highway. This split screen shows a smoothly climbing stock on the left and our speedometer on the right. Because the buyers are in total control and the price is moving fast in one direction, that speedometer will naturally read very high. Using the number 70 as an automatic trigger to sell is exactly like slamming the brakes on the highway just because your speedometer hits 70 miles per hour. In a strong upward trend, a high reading confirms that the price has significant momentum. The market is behaving exactly as it should for a car traveling at highway speeds. But financial markets don't always drive on the highway. Sometimes they enter an entirely different environment. Imagine leaving the highway and turning onto a tight, winding mountain road, with sharp switchbacks and nowhere to build up a long, steady speed. This chart shows exactly what that looks like in the market. Notice how the price bounces up and down, trapped perfectly between a horizontal ceiling and a horizontal floor. When the price rushes up to that ceiling, our speedometer hits 70. But because the space is so confined, reaching a high speed means the asset is exhausted. It has run out of room and has to break, causing the price to drop back down. The exact opposite happens at the bottom. When the price drops to the floor, the speedometer hits 30, letting us know it's time to accelerate back upward. Those popular rules about buying at 30 and selling at 70 actually work beautifully. But they only work when the market is trapped in this constrained, sideways environment. The numbers 30 and 70 mean very little in isolation. The exact same reading tells you two completely opposite things, entirely depending on the environment. This brings us to a concept called regime awareness. Before you ever look at a speedometer, you have to figure out what kind of road you are driving on. You have to look out the windshield to see the actual conditions before you look down at the dashboard. This visual shows what that means in practice. You must first look at the overall price history and ask yourself, is this asset climbing a steep hill, or is it just bouncing back and forth in a flat hallway? Professional traders use these dashboard numbers to understand the momentum within the current environment. They rely on the gauge for context rather than following it like a blind command. Once you know your road, you can safely check your speed. When you read the environment first, those dashboard numbers shift from blind triggers into useful data points that actually help you navigate.